The typical financial advisor doesn't have any clue who their clients use to have their taxes done.
Just go into a little bit of discussion with Greg Barber in regards to tax implications and your financial plan, as well as the relationship that you have with your tax advisor. So Greg, tell me a little bit about what you want me to know.
What everyone should know is that there's what I would call a tax gap. There's an area of planning that can and should be brought to the surface with virtually every single person. And often that stuff it's an abyss. It's something that's missing that many people don't even understand is the case. The typical financial advisor doesn't have any clue who their clients use to have their taxes done. They don't know if they're really using their employer cafeteria plan. They don't know if they're working on building tax-free in addition to tax-deferred pools.
So when you're talking about the employer cafeteria plan, can you just explain to me a little bit about what you mean by that?
Sure. Large companies typically have employee benefit plans that allow them to pick and choose from what I'd refer to as a menu of options or features. And obviously they're limited in the amount that they can use. Some cases they're not limited, and often those plans come with what are called use it or lose it terms. And I've seen and come to the realization that the use it or lose it rules really scare a lot of people. It really explains that if you park money into this spending account, we'll call it a medical spending account, pre-tax medical spending account, and you fail to spend all that money during the calendar year, you lose the money. And so people are so focused on not being able to get the benefit of every penny that they put in there that it's a real common circumstance they don't put enough in.
I see what you're saying.
And we're talking about a 35% savings for most people.
And that's in regards to their overall benefits plan. How do those benefits plan fall into their financial planning picture?
Well, what you find, when it comes to taxes, everybody's hyper-focused on, the current, the here and now. What's my savings this year? And often they're failing to look at the long picture. That's where, we'll talk about Roth IRAs and some other mechanisms. But with regard to employee benefit plans, those are things that are the here and now that can have an immediate economic savings. And they're just being overlooked. And again, when we're talking about 30% or more, even for modest earning, workers, this is real money that's getting left on the table.
A common misconception is that Roth IRAs are primarily for a low-income group of people. Can you explain to me how the Roth IRA impacts their financial planning picture?
That's an excellent point, and I can cover it from both sides. First of all, historically, you're right, Roth IRAs were intentionally and legislatively limited in terms of the access. If you made higher levels of earnings on your return, the dollars just simply weren't permitted to be driven into those pools. We now have a circumstance where there's qualified plans that have Roth provisions in them, and they actually allow people to save more money into that. What I find so compelling about the concept of building Roth IRA balances is that for most people, that first, we'll say, 40,000, that first 60,000, maybe the first 100,000 is actually really cheap income. I don't have a problem with people going into retirement and paying tax on that 40, 60, 100,000 in the case of a married couple. But what happens very commonly in retirement years, the same as it happened during your working years, is that something that's really significant crops up. You never saw it coming. You couldn't budget it for it. You couldn't plan for it. It just shows up. A new roof on the house, you need a new driveway, maybe there's a tax assessment because they're redoing underground water work or whatever in your neighborhood. All those are multi-$1,000 things. And the problem I have is that in retirement, nobody wants to finance that stuff. They want to pay for it all. They figure I've saved my whole life. I am the bank. I'm not going to borrow from the bank. And often that makes sense. But the key is that now that's a year that they have to pull an extra $5, $10, $20. If it's a car, maybe $30,000 or $40,000 right out of their account, very succinctly driving them into higher tax brackets, meaning they keep a lot less of those bumps. Those are the strategic years and times that I tell clients, use the Roth money. This is what we set it aside for, not just so that it could grow and generate tax-free income, but so that we could actually lower that future income in those years of excess burden.
I see what you're saying. So using that Roth IRA and using it for individuals and our clients who are not necessarily in a lower tax bracket allows them to retain their tax situation as they move into retirement.
Absolutely. It allows them to intelligently get more from the same pool of money. Admittedly, some of it you've got to save and pay taxes on today. And the long run benefit, though, can be substantial.
Wonderful. And that's what we want to do for our clients. We want to make sure that we're not just looking at today, we're looking at all the way into their future. What are you thinking of, and what are the points of interest on a yearly basis that you're taking an extra look at to how that's going to affect their taxes?
As it relates to wealth accumulation, I'm frequently suggesting, try and build as much as a quarter of your needs, your income needs, in tax-free income sources. If we're talking about non-retirement monies, it could be a muni ladder, municipal bond holdings. So they're particularly safe, they generate consistent regular income, which is great, and they're tax-free, even if the bulk of the income is tax-free, even if they're in a taxable account. Mm-hmm. On the flip side, we look at trying to build and accumulate Roth IRAs that we just talked about. The benefit of those is that they can take on extra risk, oftentimes, because there isn't a plan to withdraw those monies on an ongoing weekly, monthly basis. So they're longer view in terms of the need for cash flow from them.
So now those Roth IRAs, they have an income ceiling. How would somebody be contributing to a Roth IRA if they're above that income ceiling?
There's at least two ways. The first one that you should look to is whether or not your employer has a qualified plan that allows Roth contributions. Because if they do, the contribution levels permitted into those plans are far more than the amounts that most people recognize, the $5,500 or the $6,500 in today's dollars that can be contributed, depending on whether you're below age 50 or over. So having some is important. Having too much doesn't generate any greater benefit. So a balancing act is fine. It's good to have a significant amount of savings that are going into a regular qualified plan, say a 401k and the like, because in particular later in your career, you tend to have higher earnings, and unfortunately, empty nesters like myself find that our deductions have faded away, or people find out about all the changes embedded in the new tax code. And all those changes are not attractive. They're not all pluses. There's pluses and minuses. And you want to try and consider them all. So if I'm looking at someone, that's what I try and do. I try and get a picture of where are they positioned financially, meaning do they have enough resources but they're heavy on the taxable side, where I want to tell them to defer more income now into qualified plans, lowering their current income so it effectively it doesn't, they're not saving more in the non-retirement side of their equation, or vice versa.
Tell me, when you're evaluating a client, can you explain to me what things would make a Roth conversion attractive for a client?
Brilliant question. What I'm always looking for is a dip in income. If I've got someone that circumstantially has a dip in income, it may not even have to do with a negative employment circumstance or something. I've had people that stepped from one career into another one, and it was actually a better career, but there was 3 months or 6 month lag in between. Mm-hmm. I've had people that got promotions and had a very different comp makeup, and even though their compensation was heading up, they had a down year. So the classic example for me is the year folks go into retirement. A lot of times they retire at the end of January, at the end of February, or March. And they don't need to immediately begin drawing off of their IRAs. That first year in retirement can be the cheap year to bring into taxation and convert regular IRA money to Roth.
Now, and I know that you were indicating when you're looking at their investments, you're evaluating their tax plans. When we're talking about tax harvesting, which I know is a common conversation as well, are you looking at that in the end of December? Are you looking at that throughout the year? Are there certain points that would make you consider tax harvesting as the right time?
That's a great question. The best answer is the one that I could give you if we were working closely with our client's tax advisor. Sometimes they know in advance that this is going to be a downward year, and it would be cheap to harvest gains. And many people don't think that way. But if you're in a 15% tax bracket, gains, long-term capital gains can come in at 0. you just made taxable income tax-free by taking advantage of that timing opportunity. So in some cases, I know in the front half of the year that the opportunity's here, let's plan for it and prepare. Often, though, I will admit that it tends to be a later decision-making, later year analyses that are done. And in the best cases, when we're working with the advisor, nothing worse than a client that thinks they're in one circumstance and they find they're in another.
Absolutely. And I find that many financial advisors are not connected with the client's other centers of influence. How do you make that connection with your client's tax advisors and work together with them in your client relationships?
Well, part of it is just understanding that there's a true legitimate tax gap. Outside of that, it's just the necessity to understand and identify those opportunities in those times where it's critical. In a year of a death, as an example, classic event.
Absolutely.
Where if you're not talking with a client CPA or advisor, there's going to be significant changes. Often, someone's moving to a single tax table, and yet the income is 70, 80, sometimes 100% of what it was previously. And there's a big hit, and it calls for different planning and different actions.
So when you're looking at a client's general financial plan, and you just talked about death having a big impact on that client's financial plan, how do the estate planning documents fit into the tax plan as well as the financial plan?
Admittedly, a lot of people don't face estate taxes anymore because the thresholds for levying a tax have gone up so much. It's over 11 million per person. But I will say that in terms of reviewing and looking at their assets, it's really critical to see how they're titled, because one of the classic problems we face nowadays isn't whether or not there's going to be an estate tax, but it's whether or not assets are going to have to pass through probate. So moving assets into and properly titling them into the trust is important.
What trends have you seen in regards to the tax landscape?
For many, many years, we've basically seen tax bill after tax bill after tax bill that really effectively, people don't want to be told this, but effectively, these have been cuts over and over and over. And I won't say that all the cuts come without some losses of deductions. That's been the case too. But generically speaking, over 20 years, I've seen substantial tax cuts all the way back to the Bush era. And it's my belief that with a rising national deficit and after so many years of tax cuts that we're going to be facing some tax increases at some point. Not that it's going to be a landslide, but I'll admit that building that right level of tax-free income could end up being more valuable than just what we're seeing at today's rates.
So with that being the case, we've talked about the Roths, we've talked about the 401ks. One other item that comes to people's mind is the guarantees that annuities offer and those long-term 10-year, income situations. How does that play into your beliefs on the tax situation, as well as how does that play into the client's overall financial plan?
Annuities have a different vantage point or different comfort level with different advisors. But there's little question that one thing that they can do quite well is harbor or shelter income from the underlying investments from current taxation. Mm-hmm. So I have a tendency of being concerned about whether or not the costs embedded in an annuity are reasonable with respect to the benefits that are going to be gleaned. Maybe it's the guaranteed minimum incomes. But I can say that they're very effective at sheltering that income. And to the extent that somebody can get into a low-cost, very efficient annuity, and maybe introduce some defense and some other things that our firm is really strong in terms of holding as a high principle, then they really should be looked at. They should be considered, in particular, where someone has a lot of wealth accumulated on the non-retirement side of their investment.
Many people don't understand how expensive annuities can be and how that can affect their overall performance within an investment. So here at Executive Wealth Management, we've gone through the process of vetting tax professionals. What should you be hearing from your financial advisor in regards to your tax situation?
The importance of bringing them in to the fold. It doesn't have to be any more than that, but it would obviously help if when the advisor's in those meetings and they're not hearing all the topics that they're sometimes hearing, then that's those times where sometimes in private you need to impart to your client that, it might make sense to talk to somebody else. It might make sense to seek professionals in a particular arena of tax savings or estate planning.
And I feel really confident, obviously, in our financial advisors. I feel really confident in the tax professionals that we've decided to work with. And I know you mentioned the employee benefit plans, and really, how is that impacting, me if I'm choosing not to partake in those employee benefit plans?
Good question. So any of the dollars that you drive back off your paycheck, but into those pools of pre-tax, the ability to purchase on a pre-tax basis, essentially you're going to buy those things for 30 cents less. It's like having a coupon to buy everything cheaper, because you're able to buy them on the income you earn before federal and state taxes erode. Okay? And that's a lot of money. That's a lot of money. And if it's consistently employed, there's great benefits. You know what else I find that's pretty common? Lots of small businesses shy away from adopting these plans. And I'm not sure why, but they should, they need to be nudged a little bit. They need to be asked, why are you not taking advantage of the best stuff that's out there? Isn't it important to you that your employees and your coworkers feel this is the best place to work? And who's fooling who? Those benefit plans are part of how we evaluate and determine, is this a great place for me? And is it great in terms of what they're offering all their workers?
Absolutely.
Circumstances, each individual is different, their circumstances are different, and very importantly, the broad economy and the tax rules change every year. And it's the reason why you've got to be connected. You've got to work well, not only with your financial advisor, but also with the folks that are assisting and guiding you on your tax savings and tax planning. If that's happening and we're being defensively postured, folks are going to be getting the bulk that can be achieved and attained. And these are just choices. This stuff's available to you. The law's written. It's available to everyone. Some people take advantage of it, others don't.
And I want each one of our clients to ensure that they're taking advantage of it.
Of course.